Now, when you're looking at a price chart, it's important to keep in mind, you're not just looking at the asset that's being charted, you're looking at the behavior of the market participants. And we've seen over time these market cycles come and go, and they really resemble other market cycles of the past. There are a couple different ways that you can look at a chart or identify price trends. You've got line charts, bar charts. Today specifically, in this course, we're going to focus on candlestick charts. Now, candlestick charts have been around for a while. They originated in 1600s in Japan to study price changes in rice. In the early 90s, they were brought to the United States by a guy named Steve Nissan in his book titled Japanese Candlestick Charting Techniques. Now, let me give you the quick basis of them. There are red and green candles. Sometimes these can be represented as hollow bodies or full bodies. But essentially, a candle shows you where the price has gone given a specific period. So if I show you a daily chart or a 1-hour chart, each of these candles represents that specific time period. And the way you want to look at this is this. The entire price move that's happened during this candlestick is from the top of the wick to the bottom of the wick. Now, the body of the chart is key because this bottom left on a green candle represents where the price opened for this time period. And the top right of the green candle will tell you where the price closed for that time period. You can apply the same thing to the red charts. Now, the red charts means price moved down. The left top bar will represent the opening price, and the bottom right corner will represent the closing price. So those are a couple key things to keep in mind when it comes to price charts. Now, let me go into a couple examples of price charts with these charts right here. Now, here we're looking at a chart of Ethereum versus the US dollar, and these candles represent 15 minutes of time, and this is on the Coinbase exchange. And the first thing you'll notice is that candlesticks come in many shapes and sizes. Here's a big down candlestick in red. Here's an up candlestick in green. Here's one that's all wicks right here. But one key type and behavior I want to point out is known as the bearish engulfing candle. Now, this happens when the price of the new candle goes higher than the price of the previous candle and then closes below the low of the previous candle. So this is a bearish engulfing pattern, and it usually signifies that prices are going lower. And the reason for this is you have to put yourself in the shoes of the other market participants or the investors. Let's say you were an investor that bought this green candle here expecting price to go higher. Now, all of a sudden, this big seller walks into the market and knocks the price down lower. So if you had bought here on the expectations that prices would continue trending higher, now you're looking at more sellers. And so that's bringing out more people who are selling because now prices have reversed. On the flip side, we have the bullish engulfing candle. Now, this is a chart of Bitcoin versus the US dollar. Each of these bars represents 240 minutes, which means 4 hours of time. And this is on the Coinbase exchange. Now, a bullish engulfing candle is similar to a bearish engulfing candle, but it signifies that prices are ready or perhaps might be moving up. So right here you have a red candle, and the next one, this bullish engulfing candle, actually drops below the price of the preceding candle and then closes above it. So it closes up here. And this signifies to other market participants and other traders that prices might be rising. And just as you're looking at, prices did rise over time. They went up. This candle closed at 6,000, and then by the next day, prices were at 6,700. So these are two simple ways to use candles to identify changes in price.